If you own your home, 3 rule changes are already in effect this year, and most homeowners will not discover them until they cost money. One affects your property tax bill. One affects what happens when you sell. And the third affects what your children inherit after you are gone. By the end of this video, you will understand all 3 plus one issue almost nobody checks that can quietly protect or expose everything else you own. I am not a licensed financial or tax expert, but every week on this channel, I break down the financial information that directly affects seniors, rules that have changed, protections you may already qualify for, and practical steps that can make a real difference. Subscribe and turn on notifications so you do not miss the next update. Now, let's get into it. Home ownership is supposed to be the stable part of retirement planning. The paid-off house, the secure roof, and the asset that does not move up and down like the stock market. But the rules attached to that house are not standing still. Several of them are changing in ways that can affect nearly every homeowner over 65. Rule 1 concerns your property tax bill, and it may have the most immediate financial impact. A growing number of states and local governments have expanded programs commonly called senior property tax freezes, exemptions, or circuit breakers. Once you reach a certain age, often 65, and meet an income threshold, your local government may freeze the assessed value, reduce taxable value, or limit annual tax increases. In some counties, this has allowed a qualifying senior's tax bill to remain nearly flat for years, even while the owners of similar homes nearby saw their bills rise by hundreds of dollars annually. The catch is that most of these programs are not automatic. You usually have to apply through the county assessor, tax office, or another local agency. Some require one application, others require annual renewal. Miss the deadline, and the protection may disappear even if you still qualify. A second option, sometimes available alongside a tax freeze, is property tax deferral. Under a deferral program, an eligible senior may postpone paying some or all property taxes. The unpaid amount normally becomes a lien against the home and is repaid when the property is sold, transferred, or inherited. It does not erase the tax, it delays payment, often with interest. It may help someone with substantial home equity but limited cash flow. Because eligibility rules vary widely, check your county assessor's website or contact the office directly. Programs can differ by state, county, and municipality. Consider a homeowner in her early 70s living on Social Security and a modest pension. Her home's assessed value rose year after year, and each increase pushed her property tax bill higher. That bill consumed a growing share of her fixed monthly income. Once she learned about her county's senior freeze and submitted the required form, her assessed value was locked in under the program. Her neighbors continued paying more as local values rose, while her bill remained close to where it had been. The difference was a short application she had never been told existed. Rule 2 affects anyone considering selling, downsizing, moving in with family, or relocating to assisted living. When you sell a primary residence, the federal tax code may allow you to exclude up to $250,000 of profit from capital gains tax if you are a single filer, or up to $500,000 if you are married and filed jointly. Generally, you must have owned and used the property as your main home for at least 2 of the 5 years before the sale. Those exclusion limits have not increased since they became law in 1997, even though home values in many areas have risen dramatically. That creates a growing problem for long-term homeowners. A couple who bought a home decades ago for $80,000 and later sells it for $650,000 may have a gain of $570,000 before adjustments. Even with the $500,000 exclusion, part of that gain could remain taxable. The number that can reduce the taxable gain is your documented to the original purchase price. It may also include qualifying capital improvements such as a new roof, a kitchen remodel, an additional bathroom, a major HVAC replacement, or another improvement that adds value or extends the property's useful life. Every documented improvement added to your basis can reduce the taxable gain dollar for dollar. This is why old records matter. Contractor invoices, permits, receipts, settlement statements, and renovation records can provide a significant advantage when you sell. Someone who throws away every invoice after the work is completed may struggle to prove the actual amount invested in the property. There is also an important timing issue for surviving spouses. In general, a surviving spouse may have only 2 years after the other spouse's death to sell the home and still qualify for the full $500,000 exclusion, assuming the other requirements are satisfied. After that period, the available exclusion may fall to the single filer amount of $250,000. That difference can become especially important when the home has appreciated substantially. Another detail matters for people who move out before selling. The 2 out of 5 year ownership and residency test does not necessarily require you to be living in the home on the exact day of sale. It generally requires that you used it as your primary residence for a total of at least 2 years during the 5-year period ending on the sale date. That can help someone who moved in with family or entered a care facility before selling. However, the calendar still matters. If too much time passes after moving out, the homeowner may no longer meet the residency requirement. That is why it is wise to record the exact move-out date and review the timeline before delaying a sale. Before the inheritance rule, there is another home equity issue worth understanding: reverse mortgages and how much equity a homeowner may access. A reverse mortgage generally allows a homeowner aged 62 or older to convert part of the home's equity into cash without selling the property and without making the required monthly mortgage payment while continuing to meet the loans. Conditions and live in the home. The money may be received as a lump sum, a line of credit, or monthly payments. The loan normally becomes due when the homeowner sells the property, permanently moves out, or dies. At that point, the balance is usually repaid from the home's value, often through a sale, and any remaining equity can pass to the homeowner or the heirs. Federal Housing Administration lending limits for eligible reverse mortgages are commonly adjusted over time. A higher limit can allow someone with a higher value home to access more equity than might have been available under an earlier cap. Counseling requirements also play an important role. Before completing the process, a borrower generally must attend an independent counseling session designed to explain the costs, obligations, alternatives, and long-term consequences. A reverse mortgage can work in some situations and fail badly in others. Fees and interest accumulate, the loan balance grows over time, and the amount of equity left for heirs may shrink. The homeowner must also continue meeting obligations such as property taxes, homeowner's insurance, maintenance, and occupancy. One tax-related detail is that reverse mortgage proceeds generally are not treated as taxable income because the money is considered loan proceeds rather than wages, investment income, or a retirement account distribution. Used carefully, that may allow a homeowner to access cash without creating the same taxable income effect that a large traditional IRA withdrawal might create. That can matter because a large taxable withdrawal may increase provisional income used to determine how much Social Security is taxable. It may also contribute to higher Medicare premiums in a later year. It does not automatically solve those problems and is not free money. But for a homeowner who is house rich, cash poor, and trying to avoid a large taxable withdrawal in a particular year, it may be worth understanding rather than rejecting without analysis. So here's what I want you to do. The benefits, the discounts, the assistance programs most seniors qualify for but never actually use I gathered them all in one spot, organized by state and by program, so you don't have to dig through confusing government websites for hours. It's quick, it's straightforward, and any senior can find exactly what fits their situation. No matter what state you're in, there's help out there you're probably leaving on the table. It's called the Senior Exemption Playbook, and it's sitting in the first pinned comment right under this video. Just tap it once, and you'll have everything you need. Now stay right here, because the last one is where your house quietly turns into one of the biggest tax-free transfers you'll ever make. The inheritance rule that can wipe out decades of built-up gain the moment it passes to your kids. And almost nobody who owns a home ever thinks to ask about it. Rule 3 is where the home can become one of the largest tax-advantaged transfers a family ever makes. It is called the step-up in basis, and it affects what happens when a home passes to an heir after the owner's death. Under the current rule, the property's basis is generally reset to its fair market value on the date of death, rather than remaining at the owner's original purchase price. Imagine a house purchased for $80,000 that is worth $650,000 when the owner dies. The heir may receive a new basis of approximately $650,000 rather than $80,000. If the heir sells soon afterward for about the same value, there may be little or no taxable capital gain because the property did not significantly appreciate after the inheritance. Compare that with the owner selling the property during life. In that case, the owner must work within the $250,000 or $500,000 home sale exclusion, and any remaining taxable gain may be exposed to capital gains tax. Holding a highly appreciated property until death may produce a very different tax result because the accumulated lifetime appreciation can disappear for income tax purposes when the basis resets. This does not mean every homeowner should keep a property until death. Health needs, housing costs, family disagreements, maintenance burdens, cash flow requirements, and long-term care expenses may make a lifetime sale the better choice. The important point is that families should compare the two outcomes before a decision is made by default. Picture two families with similar homes. In the first family, the parents sell their longtime residence near the end of their lives, apply the available exclusion, pay any tax due on the remaining gain, and leave the cash to their children. In the second family, the parents retain the home until death, and the children inherit it with a basis reset to its date of death value. Both families may transfer a similar amount of wealth, but the tax path can be very different. In the first case, any gain above the available exclusion may be taxed before the children receive the money. In the second case, much of the appreciation accumulated over decades may not be taxable if the heirs sell the home soon after inheriting it. Neither choice is automatically right or wrong. The correct decision depends on the family's finances, living situation, estate plan, and long-term care needs. Home equity can also affect Medicaid planning. A primary residence is often treated differently from bank accounts, investments, and other assets when determining eligibility. However, home equity limits, residency rules, estate recovery, and exemptions can vary by state and may change over time. Anyone who may need long-term care should understand how the home is treated under state Medicaid rules separately from federal income tax rules. None of these issues necessarily requires a complicated restructuring of your finances, but each requires awareness, documentation, and timely action. Here is your action checklist. First, call your county assessor and ask whether your area offers a senior property tax freeze, exemption, circuit breaker, or deferral program. Ask about age requirements, income limits, application deadlines, and annual renewal rules. Second, gather every document connected to your home's cost basis: the original closing statement, receipts for major improvements, contractor invoices, permits and records of additions or renovations. Store digital copies somewhere your family can find them. Third, if you are a surviving spouse, review the 2-year period that may affect access to the full $500,000 home sale exclusion. Write down the relevant dates and speak with a qualified tax professional before the deadline passes. Fourth, if you are considering a reverse mortgage, review the current lending limit, expected fees, interest structure, occupancy rules, and the amount of equity likely to remain. Complete independent counseling and compare the reverse mortgage with alternatives such as downsizing, a home equity loan, family assistance, or planned retirement withdrawals. Fifth, discuss with your family whether selling the home during your lifetime or allowing it to pass to heirs better fits your goals. Consider taxes, maintenance, care needs, liquidity, and family circumstances, not taxes alone. Finally, check how your state treats home equity for Medicaid eligibility and estate recovery. Those rules operate separately from the home sale exclusion and the step-up in basis. Your house has never been just a place to live. For many retirees, it is their largest asset, a major source of security, and one of the most important pieces of their legacy. The rules attached to it can affect your monthly budget, your retirement income, the taxes due when you sell, and the amount your family ultimately receives. Now you know what to check, what records to protect, and which deadlines you cannot afford to ignore.